Well, obviously, we've ended the quarter. We're starting a new month here. I was looking at positioning after the COT report was released, and I couldn't
The
help
who report?
but the CFTC COT report, the commitment of traders. It details positioning in the futures market, Tony. And in that report, we see that positioning in VIX futures is at a really interesting level. I'm curious about your guys' take on this. Historically, 98% of the time, any given week you pluck out of the hat, you're going to find that the market has a net short speculative position on in VIX futures. 2 weeks ago, that positioning flipped to net long. That's really rare. We saw that for a few weeks at the end of October 24. Before that, it doesn't happen prior to October 23. The point is it's usually around market lows before the market explodes to the upside. But I'm curious, do you find that it's an interesting time right now that we'd have traders in the futures market structurally long volatility, because that's not something they should be doing? That seems antithetical to the Tasty way.
I'm a little confused. How are you determining that?
Yeah, because for every buyer there has to be a seller. For every seller there has to be a buyer. So how they?
Sure.
Go ahead.
So for every seller, or rather every buyer of volatility futures among speculators, there would be a seller on the commercial side, right? The bona fide hedgers, if you will. So when you disaggregate the positioning report, we can see people who are simply operating in futures just to make money. They have no economic rationale or reason to be doing so otherwise. They're absorbing the risk, if you will. So the risk takers
aren't I a
in the
speculator?
market,
Would I be considered?
You'd be considered within the bucket if you had enough money, a small speculator, if you will.
You had to say small.
I'm sorry.
Okay, so
the point is that when we look at speculative positioning in the futures market, right, for people that are operating for non-economic reasons, non-hedging reasons, they are now net long volatility, which is something that they are not privy to 99% of the time otherwise.
Yeah, I just how do you determine volatility though? I can,
/VX.
So it would just be /VX positions, but you don't know if they have a long equity bias somewhere else and they're thinking about protecting the downside, correct?
But you don't know what the option position is that offsets
or anything
that.
Else.
No, here, let me just tell you one thing about the VIX futures, just because I think it's important. I don't think that anybody trades VIX futures that's not hedging an option position.
Like in size, you mean?
If you look at
customers who trade
if you look at the VIX futures contracts, they trade a fraction of what the options trade. They're just a hedge vehicle against the options. So if the offset is in the option side. You're looking at me with those eyes. I'm just.
It's not enough. Do not take your clothes off. Okay. I mean, I know you've gotten that look before, but do not take your clothes off. I'm telling you right now.
I'm going to show you this. /VX has traded 18,000 contracts today. All right. These are just all hedging from whatever is going into the option pit. It's not the lead product. It's the complementary product to hedge the options.
And that's fine. And that's the explanation then, right? Don't read too much into this. It's not something that people should be paying attention to. The nuance doesn't necessarily matter.
Yeah, if you look at the option volume today, they've already traded probably close to 100,000 options in the VIX, and it's the VIX futures are just hedging the VIX option trades. Don't overthink that. Traders now. You could find you might be right that traders are long a little vol here. Some of the high frequency firms. It's entirely possible, but you also have to remember they tend to be long. If you're managing capital for money for like Susquehanna or Citadel or anybody else, you always want to be long vol contracts and short everything else.
What's the incentive there? Can you take that a step further?
Yeah, you can't control. So in the VIX options, you're basically you're the counter to a lot of institutional trades. So you end up with a lot of long premium. You sell it everywhere else. And what it does is it gives you your vol hedge. And so you're right in the sense that VIX traders are usually long, VIX market makers are usually long premium because they're offsetting all their short premium everywhere else from all the other customer orders. Most customers don't trade VIX options. So most of the flow that goes into VIX options is all institutional. So the market makers are always long VIX vol and short vol everywhere else.
You always have to think about what the other side has to do, because remember, they don't want to necessarily have a directional opinion in whatever trade they did. They're trying to capture edge. So it's just like with when we say that the option traders at the CBOE and any other place are the largest stock traders because they're using that as a hedge if no other order comes in, even if it's for a quick period of time against the options that they've traded.
Yeah. So Chris, if you're Citadel, right, you're making markets all over the world on every single equity there is, and you're just taking the other side of every single trade. And most customers are buyers of options. So net on balance, you're going to be short a lot of premium. The easiest way to do that is to buy vol in the VIX, and that's what they do.
But Chris, you had a question because you were saying it was contrary to what Tasty would think. Where were you going with this?
Well, I think it's interesting because when you look at how speculators behave in the futures market, they really embrace the Tasty methodology. For the large part, people are going into VIX futures and selling them. They think that volatility is going to come in. But we're not seeing that right now, right? And that's a change in behavior in what's been a constant data series going back to 2011. You don't necessarily see speculative traders hold a net long position. They're trying to always fade whatever vol spike there is. They're not doing that this time around. So that seems to be like a unique occurrence. It's worth perhaps putting that in context of the current environment that we're in, which of course tomorrow we have this big tariff announcement. You know, I was also looking at some of the seasonality for April because it's the start of the new month. Maybe you guys could help shine a light on this for me. The data for the start of April can be messy depending upon the prior year's returns. In your experience as floor traders, is that first half of April, it can be that it'd be an interesting period of unwind in the market if the preceding year was strong, like people harvesting for taxes?
Tax harvesting sound enough?
I don't see very much tax harvesting. I would say the most challenging part for me, it's always been the most challenging month for the market in the last, X number of years, has been, and for big swings and stuff like that, has always been March. April seems to be much more of market seems to normalize a lot more. I have not witnessed a lot of tax selling. If anything, I would say you probably, on balance, have seen more money flow into IRA accounts and things like that. Based on just kind of the way we see it here at Tasty, we see a lot more money coming in April than going out, generally speaking. So right. At least over the last, 25 years of running retail brokerage, we've definitely seen April to be one of the busiest months as far as account openings and money flowing in. So that means people are putting money to use. So I would say that March has been, in the last 15 years, been one of the most volatile months as far as reversals and things like that. And this year played out very similar. April, I don't sense the same thing, but I don't know.
Go ahead.
Yeah. I was looking through the data here, and just as a point of like a line in the sand, usually April is a good month for stocks for both the S&P and the NASDAQ. It's been better over the past 20 years than the past 10. But what makes it interesting is that if the preceding year was quite strong, if you look through history going back to 1950, if the prior year produced a 20% gain or more, the first half of April produces a loss of about 0.94% for the S&P 500. And then it all comes back in the second half of the month. The gains are backloaded in the second half of the month. April still ends up positive in those years. But it's an interesting dynamic now because we've had 2 years in a row back to back where we've seen 20% gains. Of course, last April, there was a geopolitical wrapping around why the market may have been declining. Israel and Iran were firing missiles at one another that ultimately culminated in the April 19th market bottom. But I couldn't help but notice this fact, right? April is a good month. There is that quirk, though, in the seasonal data that when the prior year is quite strong, you typically see a drag through the first 2 weeks. And I'm wondering if in your history you've noticed this around tax seasons following very big green years like we had last year.
I
don't look at it granular.
Yeah,
enough
I don't think I
get there.
can-
I get your play.
Yeah, I get it too. I don't think I can confirm or anything about that.
I cannot confirm nor deny that, and I will plead the fifth.
Okay.
I learned that from my dad.